My name's Sebastian Boyer. I am the approved guy, and on my channel, I talk about infinite banking, velocity banking, living on purpose, personal credit, business funding, estate planning, asset protection, and succession planning. Just a little bit about myself. The reason I go by the approved guy is because of my faith and what I believe, which is that I am approved by God to have eternal life through Jesus Christ. And as a result, I'm also approved to spread the gospel and the good news of Jesus. At the same time, any knowledge and information that I come across that is truth, that has benefited me in any way, it is my obligation to also share that knowledge and information. My purpose is to help other people to grow their knowledge, expand their territory, extend their dominion, and be able to basically have authority in life, and therefore leave a contribution to the world and leave generational wealth behind for their future generations. That's not just financial, but that's knowledge, that's wisdom, experience, and financial generational wealth. So the scripture says to build up treasures in heaven, and that's what I'm here to do, is to share my knowledge. That could be spiritual, that could be financial, my experiences. The topic here is Let's Talk Tuesdays. I don't want to come into this with an agenda to sell anything. My purpose, again, is not to sell, but it's to educate. So one of the verses that I'd like to just touch on, and guys, if you're watching this now or later on the replay, this is my first time, so I'm going to make mistakes. I don't even know if you're hearing me loud and clear. If you are hearing me, if anyone's watching, I might not have anyone attend this video, this live stream, because this is my first one and I didn't promote it on purpose because I want to work out the kinks. Well, thank you. Whoever just gave me a thumbs up. Just say hi. Tell me your name. I just want to give you a shout out. Thank you for joining the live stream. So real quick, let's just take a look at this verse here that I go by. So Timothy, 2 Timothy chapter 2, verse 15 says, do your best to present yourself to God as one approved, right? So I know that I'm approved because of Jesus, right? But I have to still do my best to present myself to God as one approved, which means that just because I'm approved doesn't mean that I can just do whatever I want, live my life however I want, and just act as if no matter what I'm going to be forgiven, so who cares? No, that's not how this works. If you're truly forgiven, if you truly believe, then your heart response is to do your best to present yourself to God as one approved. And that's exactly what we should all be striving to do. But that's why my title or the name is The Approved Guy. A worker who does not need to be ashamed and who currently handles the word of truth, right? So a worker, a lot of times when we hear that word worker, we think of job. But scripturally, the word worker, God created us in the beginning, in Genesis, to be workers. That is our purpose. And a worker is not one who has a job, but it's one who has been given authority over God's resources. So the resources that we have, money is a resource. Relationships, assets, these are resources. So if we have access to resources, we are workers, and our purpose should be to replenish and multiply those resources. As it says in Genesis, God said to go out and multiply, be fruitful, multiply, replenish, subdue, and dominate. That's what God says to do. And that is business 101 right there. It's all about being a good steward of the resources that God has given us. So that's what this is about. I see a couple people have joined, and so I just want to say, hey, thank you for joining. David Soto, thank you for joining. Thanks for letting me know you can hear me. Hi, Wendy from Ottawa, Canada. Thank you for joining. Please, as I continue to talk, as we dialogue, what's going to make this interesting and valuable is not me just chatting away on what I want to talk about, but it's to talk about what you guys want to talk about. So again, just to reiterate, my topics of conversation are infinite banking, velocity banking, living on purpose, personal credit, business funding, estate planning, asset protection, and succession planning. So at any point in time, if you have a question on any of those topics or anything else that we're talking about as we go through this live stream, please share your thoughts, your questions, and let's dialogue. All right, so let's keep it moving. So as I was saying, our purpose should be to identify what it is that God created us to do and why we are here in terms of why the gift that we have. So if you look at your gifting is going to be the thing that you're really good at, right? That you also enjoy, right? If you don't enjoy it, it might not be your gifting. You might be really good at it, but it's not necessarily your gifting because you don't love it, you don't enjoy it. And on the other hand, you might love something, but you might not be good at it. So it has to be a combination of what do you love to do that you're really good at doing, and therein may lie your gifting and your purpose to bless other people and share that gift with other people. So for example, personally, I love to sing. I love singing. Okay, guys, you'd think I was a singer, except when you hear me sing, I sound terrible. I sound like a donkey howling at the moon. It's terrible, right? But I love singing. That is not my gifting, right? As much as I love it, I'm terrible at it. So definitely not going to get on stage. I'm not going to record myself singing. But on the other hand, I love teaching, right? And I'm pretty good at it. Everyone tells me, hey, you're really a good teacher. You're really good at breaking down complex information and simplifying it in a way that helps me to understand things. I've heard that over and over and over throughout the years. So I decided that that is my gifting. That is my gifting, and I've then stepped into my purpose by doing exactly what I'm doing right now, which is teaching. I'm coming live. I'm using this medium as a way to reach you in the marketplace, which is exactly what we're supposed to do. We're supposed to gather and share our knowledge and our wisdom. All right, so that's who I am. That's my identity is in Jesus, is in Christ, and Timothy, 2 Timothy verse 2:15 is do your best to present yourself to God as one approved, a worker who does not need to be ashamed, and who correctly handles the word of truth. There's many other verses that touch on the word approved that we can read through that have great value and power. But today we're just going to leave it at 2 Timothy chapter 2, verse 15. All right, so let's kind of touch on each of these topics here. This is my website, The Approved Guy. You can just visit that at theapprovedguy.com. And the first topic here you'll see is infinite banking. So really quickly, if I had to explain infinite banking in 30 seconds, infinite banking is using a whole life insurance policy with a major mutual company that allows you to allocate the majority of your premium towards the cash value. Because it's a major mutual company, you're able to share the dividends on that cash value from the insurance company. So your cash value is going to compound interest. You are then able to borrow against that cash value to invest in your business, pay off debt, pay for school, invest in the market, whatever you want to do. And your money is essentially protected by the death benefit. And it's also protected from any litigation inside of that life insurance policy. So this is a strategy known as infinite banking. Also, become your own banker, your family bank. It has a lot of different marketing terms that have become very popular over the years. But at the end of the day, it's really an alternative strategic saving strategy. That's what it is. It's an alternative strategic saving strategy. It's not an investment strategy. Unfortunately, in the life insurance space, there are a lot of life insurance agents that use the strategy as a way to sell life insurance, but they're not designing the insurance policy properly, where it's not optimized for the strategy. Instead, what they're doing is they're making their pockets fat by using the concept of the strategy to sell, and then they sell you an insurance policy that's not ideal or optimized for practicing infinite banking. So if you ever get an offer for infinite banking using an IUL policy, no, that's not what it's designed for. This is not an investment strategy. This is a strategic saving strategy. So we can talk more about that. If you have any questions, please post it on Infinite Banking. I'm going to come back to that and show you guys an example of an illustration in just a minute. All right, so the next topic is velocity banking. Let's go back to the page here. So velocity banking, the premise of velocity banking is to eliminate debt as fast as possible, right? So how do we do that? We eliminate debt as fast as possible by using a line of credit. It could be a personal line of credit, a business line of credit. It could be a HELOC, first lien, first position, or second lien, second position HELOC. Either one is going to be ideal. You can even practice it with limitation and restrictions using credit cards, but that's not ideal for practicing velocity banking. It should credit cards would be more of a subsidy. It'll be an additional feature to add on to your strategy. But with velocity banking, what you're doing is you're using the line of credit as a premise of paying your bills and your expenses, and strategically calculating a large chunk to be paid out of the line of credit and pay off a large portion of debt. There are rules to follow. There are a lot of research that has to be done in terms of the amounts, the dates, the times that you're initiating these transactions. And by keeping your income inside of the line of credit, by putting all your income in there, what you're doing is you're pushing down the average daily balance of the line of credit, and therefore it is not accruing interest as it would if you only sat on the minimum monthly payment. And then because you're able to spend out of the line of credit, you then pay your bills and expenses through the line of credit, and that average daily balance is being pushed down by your income sitting in that line of credit. So that's velocity banking. I was taught this strategy by an amazing teacher. His name is Denzel Rodriguez. Shout out to Denzel. Denzel's channel is the Finance Geek, or Denzel Rodriguez. You can look him up on YouTube. He has hours and hours of content illustrating velocity banking, and you can learn more from him on velocity banking, and you can get a consultation from him and from me. I will also put up a discount promotion code if you want to use his services to learn from him for velocity banking. All right, living on purpose. So this goes back to my purpose in identifying and learning who I am, my identity in Christ, and basically hoping to help other people come to understand their identity and what their purpose is, and to live on purpose. Quick story: I had a client. This was about a year and a half, 2 years ago, who she contacted me looking for financing. And she really didn't know what she wanted to do, but she found a multi-level marketing company that she wanted to go ahead and plug into. And she was like, well, I'm going to start this multi-level marketing, and I want the funding to help me, market and promote my business. And I said to her, well, great, that's awesome, but tell me, what about this multi-level marketing do you love? Like, have you used the product? Do you love it? And is this something that you feel that you're really good at? And is it gonna bless other people? And she basically said to me that, no, I'm just looking at this because I can make a lot of money. So I said to her, that's great, because there is a time and a purpose for a business where the sole purpose of that business is to make profit. It's not living in your purpose, but it's a business whose purpose is to make profit, right? But that should be one of your additional businesses. Your primary number one business should be the business that is your purpose. It's the one that you are sharing with the world, your gift, which is what you're really good at, that you love to do. All right. If you make that your business, then you're never going to actually feel like you're working or that you're have a job, because you're going to enjoy doing what you do. You love it. And therefore, you're going to just feel like you're having a great time helping other people with your gift. And that's going to be a blessing to others and a blessing to you. But you may want to have another business that is strictly about making money. And that business is simply, a profit making business. Maybe you're going to fix and flip real estate. Maybe you're going to invest in the stock market. Maybe you're going to invest in Turo and do car rentals, whatever it may be, whatever you find as a way that you can make revenue or income. The purpose of that business may strictly be for that, right? But ultimately, we want to identify what is our purpose, and we want to live on purpose. So this client, I told her, we talked about that, and she happened to be really good at sewing, and she said, "Well, I can't make any money sewing." And I said, "What, are you kidding me? You could make lots of money sewing. Not only can you teach other people, but you can get hired to, sew clothes and design clothes, and you can teach people on YouTube, where the marketplace is." So she said, I'm going to think about it. She called me back a week later. Sure enough, she's in the Caribbean community, and her community, they do a Caribbean festival, carnival once a year, and the costumes for that carnival are extravagant. I mean, it's very intricate sewing with very intricate beads and very beautiful, very colorful and vibrant uniforms or outfits that they wear. And every year, every carnival, they get new outfits, new uniforms. There has to be uniforms that have to be repaired. So after our conversation, she made a few calls, and sure enough, she started getting orders to repair and to design and create new outfits. So she launched her business with her expertise, which is the thing that she loves to do, which she's really good at, and that was to sew, and she's making money doing it, and she has a successful business. So that is awesome, right? That's a beautiful example of someone living on purpose, doing what they love to do, that they're really good at. All right, so that's living on purpose. Okay, so the next topic is personal credit, right? So we live in a world where credit is very important, unfortunately. If you don't know, I am a finance director and partner with Orange 5 Business Funding, and we help people get access to over 12 business funding solutions. That could be SBA 7A loans, equipment financing, asset-based lending. It could be term loans, invoice factoring, receivables, lines of credit. It could also be 0% interest promotion, personal and or business credit cards. So there's a lot of funding options. All of these funding options, the number one thing that we have to look at is your personal credit. How is the personal credit? And I talk to a lot of people that have been in business for many years or looking to start a business, and they have no credit. They're 30, 40, 50 years old. They have nothing on their credit because they don't believe in credit. Their philosophy of life is do not have any credit. Only pay for cash for what you need. And I don't disagree. You don't want to have credit and get into debt and where the credit is against you. But if you are a good steward with credit and you are a good manager, then there's a whole lot of value in leveraging credit. Not only can you get cashback points and rewards points and travel points on credit cards, but you're going to build up a personal credit profile that is going to allow you to qualify for a mortgage, to qualify for car loans, to be able to buy your investment properties, to be able to invest in your business. Without having credit, you're going to be very limited. So now you're 40 years old, 45, 50, 30, whatever your age is, you have no credit, you're trying to get funding, you can't qualify, and you're going to need to spend about 6 to 12 months creating and building credit. So I am not a credit repair person. I don't repair credit, but I do teach and I coach you how to establish new credit, build credit, and get access to funding using your credit. So again, anyone on the live stream, if you have any questions about your credit, please post a question. I'd love to elaborate. But basically, you want to have good personal credit. You want to have between 3 to 5 credit cards. The older the credit cards, the better. Meaning, don't ever cancel your credit cards. That's the number one bad move that I see people make, is they cancel credit cards. And the reason why is credit cards are revolving, which means that as long as you take good care of them, they're never going to go away. They're going to stay on your credit forever. So use them sparingly, just so that you keep them active. And if you're going to be strategic about it, you can leverage them where you use and take advantage of the rewards points by spending with the credit card, buy your groceries, pay for your gas, and then immediately, same day, pay that right back. So you don't get charged interest, but you gather points. Because if you do that, then you're going to get so many points that you can travel for free. You can buy all your Christmas presents using your rewards points, or you can get cash back and use that to make your payments on your card. So leveraging the rewards points, cash back, and travel points in itself can be a stream of revenue and income that you can take advantage of if you leverage credit cards. Don't use the credit card to buy stuff that you can't afford, where you're sitting on debt and paying a minimum monthly payment. If you're doing that, then that's the worst thing you could do. Credit cards have compound interest, and it's very expensive, and you don't want to sit on credit card debt. But if you leverage the credit card, you can build credit. Your credit cards are never going to go away because you take good care of them, use them sparingly, or use them by leveraging them. And that's going to give you a good credit profile. But you also need to have a little bit of a mixture of credit. You want to have maybe a car loan, a personal loan, and a mortgage, or some other debt that's not credit card debt on the credit report. So typically you want to have about 4 to 5 accounts, 3 credit cards, 1 or 2 other loans. That's a good mixture of credit right there. And again, the longer you have these accounts is the more credible you are, and therefore the reward is your credit scores go up and up and up. Okay. Now, if you don't have any late payments on your credit, you have no collections, you have no bankruptcy, you have clean credit, and you have a good mixture of credit, and your scores are low, then it's probably because you have high credit card utilization. Ideally, to keep your credit card balances under 30% is going to give you the highest credit scores. And you can leverage credit for a time being if you're going to invest it in a business or in an asset that's going to give you a return on investment. So for maybe 3, 6, 8, or even 12 months, you may go through a period of high utilization, which is not negative. It's not derogatory. As soon as you pay your credit card balances down to under 30%, and those balances update and reflect on the credit bureaus, your credit scores will go back up higher than they ever were. So do not be afraid of credit, but understand it. Be a good steward and manager and leverage credit. For more information on how to properly and wisely leverage credit, feel free to schedule some time with me. I'm happy to talk. Okay? The next topic is business credit. And just like personal credit, business credit has the same value, right? It's going to keep getting bigger and bigger and bigger, but it's completely different. Your personal credit is reporting to Experian, Equifax, and TransUnion, while your business credit is reporting to Dun & Bradstreet. It's reporting to Experian Business Credit and Equifax Business Credit, right? So the business credit does require a more strategic approach to establish and build that business credit profile. Now, there's a lot of confusion and a lot of opinions on how to build business credit and whether or not you even need to build business credit, because you can, in fact, get approved for business credit cards as long as you have really good personal credit. You can still get approved for business credit cards, but there are certain loans, term loans, lines of credit, SBA loans, that after a certain amount of time, after 2 years in business, they're going to be looking at your business credit. And if you don't have any business credit, you may not be able to get qualified or approved for that debt because you're lacking the business credit. If you build up your business credit strong enough, you can eventually purchase assets like vehicles. So the car you drive, you can make that a business asset that's 100% guaranteed by the business with no personal guarantee. It doesn't show up on your personal credit. Your business owns it. It's guaranteed by the business. It doesn't show up on the personal. And as a result, it's a business tax deduction, and it completely separates that liability, right? So that's crucial. But taking a step back, liability, one of the reasons you want to form a business and have an LLC is to separate liability and also for the tax advantages, right? When you put assets inside of an LLC, if you purchase property inside your LLC, there's a level of protection on those assets because the LLC is protecting it, right? Where if you own the asset, it's vulnerable. Now, there's layers of protection, and this gets into other topics that I teach, which is asset protection, which we're going to touch on later. But one simple thing that you can do is form an LLC. Basically, you create a company with the Secretary of State, an LLC. You go to irs.gov, get an EIN number, and voila, you have an LLC. You go to the bank, open up a business checking account, and you're in business. What you don't want to do is, if you are starting a business, work as a sole proprietor, right? That is not going to work for building business credit. It's not going to work when it comes time to get legitimate loans from banks and lenders. They do not want to look at and accept sole proprietors. So don't waste your time there. Establish a business. I recommend an LLC to get started. Get your EIN number. Get a business checking account. Start building your business credit on your EIN number. Start getting access to funding. All right, so I'm going to take a sec here, and let's see. We have a question from Wendy, and the question is, does the 30% apply to lines of credit? Great question, Wendy. So if you're talking about like a line of credit that's not associated with a credit card, the answer is no. It does not apply. So you're not going to be penalized on your credit report if you have a high balance on a line of credit, whether that's a HELOC, a PLOC, or a BLOC. So it's the reason why is because credit cards are so easy to spend. They're a lot more volatile in terms of risk, and so you're penalized when you have high utilization on credit cards. But if it's a line of credit of any sort except a credit card line of credit, then as long as you pay your monthly payment on time, then you're not going to be penalized by having a higher balance on that line of credit. Okay. Now, at the same time, obviously, you don't want to necessarily overextend your lines of credit either, because then that puts you at risk in terms of paying higher interest later on if you're applying for other debt. And that's going to be more difficult for you to pay off over time. So I always recommend keeping your utilization on your lines of credit at around 60%. That's a good number to practice velocity banking. No more than 80%, depending on what your cash flow is. You want to always underestimate your income and overestimate expenses, and don't over leverage your line of credit. That's just good advice. I hope that helped. All right, moving on. So business funding. So business funding can come in many forms, right? Like we said, SBA, there's the SBA 7A loan, there's the 504 loan, there's equipment financing, asset-based lending, term loans, so many different types of financing solutions that you can take advantage of. Some options that are available out there are much more aggressive and very expensive. And that's going to be probably the most popular funding program that people take advantage of. I had a phone call with a lovely lady earlier today who, unfortunately, her business was doing great, but she got these phone calls to take advantage of a cash advance. And the way they pitch it is they tell you there's no interest rate. It's a factor rate. It's the payment comes out automatically, so you don't have to worry about it. You're not going to feel it because it's going to be a percentage of your income or of the revenue as you bring it in, and it'll just come out weekly or daily You won't even notice it. And your factor rate is 1.25, or it's 1.45. So you don't know any better. And so you think that sounds good, but what that translates to is 25%. It also, or 45%, and they sell these loans at 25, 35, 45% with daily payments over 3 months and 6-month terms. Now, there is a time and a place for that. If you have bad credit and you have revenue in the business and you're in a do or die situation, or you have such a huge opportunity where you're going to make 150% return on investment in a short span of time and you have no alternative, then maybe consider a merchant cash advance. But if you have decent credit, you can get much better loan options with regular monthly terms with interest rates between 10 to 20%. That's typically where you're going to see business loans at 10 to 20%. Even an SBA loan right now is prime plus 3%, which is 8.25 is prime, and then the bank rate is 3%. So we're at around 11.25% on SBA loans. So anywhere between 10 to 15% on a business loan is not that bad for a business loan. Remember, this is money that you're investing in a business that's giving you a return on investment. This is not a mortgage that you're sitting on that's not giving you anything back in return. So obviously, you want to try to get lower rates if you can, but that's where you're probably going to see a lot of business loans at, in that range right there. So with that said, she took one cash advance. He told her, the salesperson told her that if she does this, it'll build business credit with that company, and in a few months they can offer her a line of credit. Sure enough, that didn't pan out. She now needed help. He told her, well, if you get another one of these loans, that'll help you to make your monthly payment on this one. So then she ended up with 2 of them. I had a client about 2 years ago who had about 6 of them, and she had about $2 million in cash advance debt. Thank God I was able to get her approved for an SBA 7A loan to refinance that. She was paying basically 40% interest with a daily payment, and it was just completely drowning and choking her business. And with these companies, most of them don't offer any prepayment advantage. They don't offer any discount when you pay early. Not all of them. Some of them do, but most of them don't. And she had good credit. She had no business taking those cash advances, but she didn't know any better. And they have boiler room operations. They're slamming your phone every day. I get 5 calls a day myself, for these cash advances. And so, look out for that. If it's a daily payment or a weekly payment, you want to ask, okay, well, what am I actually going to pay back? And then do your math. And if it's anywhere near 20, 30, 40%, unless you have terrible credit and you're in a do or die situation, I would advise you to stay away from that. Don't do it, okay? You can probably qualify for a much better product that's going to help you leverage and grow your business. So I am definitely an advocate to stay away from cash advances. I definitely recommend, if you have them, try to refinance, get out of those advances, get into better products. And then that's leading me to the next topic. Well, actually, that kind of leads me back to the first topic, which is infinite banking, because ultimately our goal should be to never to have to borrow money from the banks ever again. So that this way, if we build up our own bank inside of our infinite banking whole life, high cash value with a major mutual company, strategically, optimally designed for cash value, compound interest growth, if we set that up in due time, based on your existing savings that you have now, you just redirect it over there. In due time, you'll be able to build up enough bank where you can use it as collateral for a loan, and eventually you will never have to borrow from banks again. The sooner you start is the sooner you'll get there, right? This doesn't happen overnight for most people. This can be a process that can take several years of building that bank, of saving and seeing that compound interest occur inside of your policy. So that should be our overall goal, is to eventually get out of debt, eliminate any personal or business debt through velocity banking, get ourselves in a position where we become our own bank with our infinite banking policy strategy. And then from there, we redirect cash flow into our business and in our investments to start generating more and more income and revenue, which can be then reinvested back into our policy to create more compound interest growth. And ultimately, we're going to be ready for estate planning and asset protection and succession planning. So estate planning is basically setting up a trust, and the most popular way to do it is with a revocable living trust, which is the least expensive way to put your assets into the trust. And that could be your property, your vehicles, any expensive jewelry, anything of value, into the trust. You fund your trust, and your trust has rules and laws. And so with your trust, you then are able to, when you die, basically, that trust has rules and laws, and immediately your attorney will turn it into an irrevocable trust on your death. And then all of your assets that are in the trust, including generational wealth through death benefits on life insurance, all of that sits in the trust and completely avoids probate. Probate is what happens when you don't have a trust. So even if you have a will and testament, your will and testament goes to probate. That could be very expensive. It could take months before a judge defines the final verdict on the will to release assets, especially when you have young children. That could be something that you don't want your kids being caught up in the system, that for a judge to decide who gets to take care of them. If you have a will and testament, you put it inside the trust. Your trust, your word is bond inside of the trust. And as soon as you die, that word becomes effect. It becomes flesh. And so therefore, there is no probate. It goes, whatever you said, it becomes instantly applicable, and nobody can second guess what your trust, the laws and the rules of your trust say, including your assets as well as your will and your testament. Okay, so I'm going to take a pause, and Wendy, thank you for sticking with me here. You're still trying to understand velocity banking. Okay, so the best thing I could tell you to do, Wendy, is visit this channel. Let me take you there. Hang on just a sec. Because this is how I learned it. This is who I learned it from. And this is honestly, he is the master guru. He is my mentor when it comes to velocity banking. And his name is Denzel Rodriguez. So this is his YouTube channel. Okay. He has over 800 videos. Some of his videos are 20 minutes. Some of them are over an hour, 2 hours. And he literally runs illustrations, based on different case studies, right? So his clients give him the okay to use their numbers. And so let me go ahead and just click on an example here. Let's see. Let's get past that commercial in a sec. But basically what he does is he runs the illustrations for you. And he does it in a timely way where, where it's a step-by-step process. So as you see, he runs the numbers. So I'll use his example on the board here really quick. Okay. So first thing you need to do is you need to know what is your monthly income. Okay. Once you know what your monthly income is, then you need to separate your expenses. Then you need to separate your debt. Your expenses are your ongoing living expenses, which is going to be, your gas, your food, the things that the light bill, they're always going to be there. Okay. And then you separate your debt from that, because your debts eventually, they have an expiration date. So separate those two things. Okay. Then at the end of each month, after you pay your bills, which are your expenses, and your debts, what's left is your monthly cash flow. So you need to know that. These are your 4 major numbers. If you send me an email, I can send you a link to download your workbook, and you can create a spreadsheet for yourself to reference. Then you need to list all of your debts, and you want to list them in order by the highest interest rate. Okay? Then you need to get your hands on a line of credit. Now, first, you also have to understand that there are many different ways of practicing velocity banking. Okay, one way is with there's many different ways of eliminating debt or debt strategies. Okay, one way is called debt snowball. There's debt avalanche. These are popular methods by Dave Ramsey, which are very conservative and they 100% work. And what those ways say is that you take your extra cash flow, you pay them into your highest or your lowest debt. Debt snowball says pay your lowest debt first, pay that off, and then redirect that cash flow and the payments that you are making on the minimum on that lowest debt, redirect it to the next debt. So that's debt snowball. And if you don't have a line of credit, a personal line of credit, a business line of credit, a HELOC to use for your velocity banking, then you have to practice debt snowball first. Okay, that's a safe, conservative way to eliminate debt. Once you can get your hands on a line of credit, then you can really practice velocity banking because you're going to use that line of credit as your premise where you're going to put all of your income into that line of credit and you're going to pay a large chunk out to your debts once, and then you're going to continue to put your income in that line of credit, pay your minimum monthly payments on all your bills and debts. But by putting your income in that line of credit, it pushes the average daily balance down. And so the interest that you pay on that line of credit is going to be a lot less than if all you paid was the minimum monthly payment. And you're going to get the balance of that line of credit back down to zero within 6 to 12 months. Once you get it back down to zero, you're going to do another chunk. Now, the amount that you chunk, the date that you chunk, that's going to be something that we'd have to strategize on a one-on-one session based on your 4 numbers. But to learn the strategy in more detail, I would really recommend, Wendy, check out Denzel's channel, watch a couple of his videos, learn, take notes. I promise you, you're going to get extreme value. If you prefer to work with Denzel, let me know and I'll give you a link as an affiliate and a discount code for his services. But you could also go through his content, and then when you're ready to actually plan your numbers, then you can schedule a one-on-one coaching session with me as well. You'll see a link in my description below to do that. All right. So if that's so far, if this is good value, anyone who's watching, I think, Wendy, you might be the only one left right now. I'm not sure if David, if you're still with us, say hi. But I only see 1 like. So if it's just 2 of you here and you're getting good value, please please let YouTube know that I'm doing a good job just based on who's here now. Okay, guys, I appreciate that. But yeah, I definitely recommend check out Denzel's channel, learn from him and his content. He definitely is the guru in this space. He's my mentor for velocity banking. I practice it, but I watch his videos at least once or twice a week to learn from him. Okay, and then when it comes to infinite banking, there's a few other sites. He also talks about infinite banking on his channel, but you might want to check out Chris Kirkpatrick, which is Life 180. Chris is also my mentor. I'm an agent in his agency, Life 180, and so you can learn a lot about life insurance and the different products, why you should never buy an IUL. Chris is a huge advocate of never buying IUL, so I definitely recommend him. You could also check out Better Wealth. They have a great channel. They talk a lot about infinite banking, and they teach the strategy. So yeah, definitely check out Better Wealth. So that his name is Caleb, and he has great content. Him and his partner Dominic. They basically call the program the AND asset, because this infinite banking is a tier 1 asset, and it's your AND asset. It's the asset that you have that you're going to use to empower all of your other assets. It's your AND asset. So I love these guys. They teach the strategies. They do illustrations, and I'm going to go ahead and jump in and do an illustration, or show you guys an illustration in just a second on an infinite banking policy. But I hope that helps. Definitely, I think you'll get a lot of value from learning from Denzel. Okay, guys. All right. So that's we talked about estate planning. Now the next topic is asset protection. Now it's very important because what asset protection primarily deals with is also a trust, right? But people try to use an estate planning trust, what we talked about, which was a revocable living trust, which is really to protect assets as they go into probate, as an asset protection trust while they're living, and that does not work. That does not work. Okay, because since it's revocable, a judge can tell you to change the rules inside of the trust, and you would have to follow what the judge commands. So if someone's trying to sue you for an asset and it's inside of a revocable living trust, a judge could be penetrated. But an irrevocable trust is much more difficult to penetrate, especially in certain states. And of course, for both of these services, you need to work with an attorney. So in the asset protection space, I work with an attorney group known as asset protection attorneys. And this gentleman here has a channel, and I refer my clients to them. So the business guy, and he has hundreds of videos all about asset protection. And what he's going to guide you to and show you is to truly protect your assets in the long run. And again, if you don't have a lot of assets, just having the revocable living trust for estate planning is enough. Get a will and a testament, put it inside of the estate planning trust. But if you are investing in assets, you have multiple real estate properties in your portfolio, you have businesses, and you're concerned about anyone suing you, then what you want to do is you want to set up an asset protection trust. And what he teaches, what the business guy teaches, is that the asset protection trust ultimately should be set up as an offshore trust. There's certain islands, three of them would be, one is in the Bahamas, another one is Nevis Islands, and then Cook Islands. So Nevis and Cook Islands give you the biggest, most protection, and it's all about jurisdiction. That's what it is. It's all about jurisdiction. And so when your assets are in a trust, and that trust is in Cook Islands, then your assets are pretty much secure and safe from any litigation. But don't take my word for it. I'm learning just as you are, and I'm learning from the business guy about asset protection trust. Him and his team, they're attorneys. He has the longest standing law firm that has produced the most asset protection trust in the country. So if you check out the business guy, learn from him. And if you'd like an introduction, let me know so that you can get a discount, and they can help you with that. But again, if you're not really there yet, what I recommend is Trust and Will. And Trust and Will is going to give you help you with an estate planning trust, which is basically going to protect your assets from probate. And again, I can send you a link if you send me an email to take advantage of Trust and Will. So this is going to be more for estate planning with a revocable living trust to protect assets from probate, where what the business guy teaches and what they provide in their law firm are asset protection trusts. Okay? And the last topic is succession planning. So succession planning is, as a business owner, how are you going to retire eventually one day, leave behind your business, and who is going to step up to take the position of leadership in your business, and how are you going to set up your business to continue to thrive so that your legacy doesn't end when you leave the company, right? So that's succession planning. Proper succession planning has to do with leadership development, and it has to do also with setting up the parameters for a very seamless transition of authority from department heads, especially from yourself as the business owner, if you play a major role in the success of your business. There could be a key person insurance policy that's a part of that process, and that could also be beneficial in a buy-sell agreement with partners. So succession planning is very important. One thing to note, the only word in the entire English language that has the word success in it is succession. So true success is not only defined by what you're able to accomplish for yourself, but it's defined by what you're able to accomplish through others and being able to help other people to step up into positions of authority to be able to then continue your legacy in their life and in the next generation and in the next generation and in the next generation. That is true success. An example of this would be Solomon, King Solomon. You know, we're here almost 3,000 years later, and we're still talking about King Solomon. We're still talking about, you know, the things that he's done, his wisdom, how he practiced his business. One thing I would recommend is researching the King Solomon business model. And on another video, I'm going to illustrate what that looks like, the King Solomon business model. All right, but without further ado, let's jump into an infinite banking design. So you can just go to my site to take a look at this illustration. On this page on my website, you're going to see a book called Become Your Own Banker. Nelson Nash is the author of that book. He's considered the godfather of infinite banking. Great book to read. I recommend it. If you click the link right here, it'll take you to that book so you can buy it on Amazon. And I recommend reading that book if you're going to practice infinite banking. But what makes this work is the IRS tax code section 7702, because this tax code right here basically is where it defines life insurance and the life insurance contract as being the only place that you can put your cash, and it can grow, and it can grow cash. It can grow tax-free, and that's what makes it so powerful. It's tax-free growth on your cash value, right? So I'd recommend clicking the link, reading that, familiarizing yourself with section 7702, and this is right from irs.gov that I'm linking you to there. Okay, so just adding some credibility. Okay, so right up at the top here, I have two examples of a life insurance design with a major mutual company. One is for a 39-year-old who's going to be saving $10,000 a year, and then another one is for a 39-year-old who's going to be saving $100,000 a year. So let's take a look at that one, even though we'll kind of glance back and forth at both of them. And so first, let's look at the $100,000 savings scenario. Let me zoom in on that a little bit. Okay, so we have a 39-year-old male, non-tobacco, and he is saving $100,000. So let me explain to you what you're seeing here. He has an initial monthly premium of $920.70. This is his base cost. This is his hard cost and his commitment to the life insurance company. He has to pay $920.70 a month. Otherwise, his policy is going to lapse. Okay? So that is a commitment to the insurance company. Okay? But if you look, he has a lump sum available, which is a PUA, which is paid up addition. This is basically a savings vault, a space that he can dump cash into. Okay? And he has the ability to dump $100,000 a year into that saving space. If he doesn't put in $100,000, he is not penalized. He doesn't have to do it all at once. He can do it in increments. He can do it, a little, $1,000 one month, $20,000 another month. If he only puts in $50,000 for the year, there's no penalty. Now, obviously, the design and the illustration I'm showing is under the assumption that he is going to put $100,000, and we don't want to purchase a policy if you're only going to put $50,000 with a lump sum ability of $100,000, because you are paying for that in the base cost. So let me show you now someone saving $10,000. You're going to see the base cost is a lot less. It's only about $150 a month. And this one, he can save $10,000 a year. Okay? So as you saw on the other one, his base cost was a lot higher because why? Because he's saving $100,000. So we don't want to set up a policy where we have a saving space that's too big because you're going to pay for it on the base cost. Okay? It's much wiser to start with a smaller policy, and then let's say you started with 10,000, you hit 10,000, and now you want to do more. Well, you can't. Not with this policy. These are the limitations. If you overfund a policy, it becomes what's called a MEC, which is a modified endowment contract, and all of that compound interest growth becomes taxable. So we want to keep it as a life insurance contract, which means we want to stay within the parameters of what the life insurance company tells us is safe in terms of the amount that we can put in above the base premium. Okay, so let's go back to that big one, to $100,000 a year. Okay, so we have our base of $920.70. That's a commitment to the insurance company to pay for the insurance policy. That, in this example, is purchasing, and if you look at this far right column here, this is purchasing a death benefit. Here, let me click that on top of that. Okay, this is purchasing a death benefit here of $1.8 million. Okay, that's what the $920.70 is doing. But it's also giving me the ability to put $100,000 into the policy. And that's my cash value, which is my savings space or my alternative savings space inside of my insurance policy. Okay, now that is where I'm going to start gaining compound interest growth on that cash value. Okay, so if we go down here now, on the left side, we have a guaranteed column. And then on the right side, we have a non-guaranteed column. And the reason is, in this example, this insurance carrier is guaranteeing 3% on your cash value. On the right side, the non-guaranteed is the dividend scale. Now, we can go back 100 years, and we can see that this insurance carrier, along with about 5 or 6 other major mutuals that we could use to design these policies, historically have always paid their dividends. Now, the dividends can fluctuate yearly. So last year, this insurance carrier was 5%. This year, their dividend is 5.25. So next year, it could be 5.5 or it could go back to 5. So it's going to fluctuate a little bit there. And that's why they can't use the word guaranteed. But you can expect, or you can bank on the fact that you are going to get dividends. And of course, this illustration is based on this year's dividends of 5.25%. Okay, so if you want to look at the guaranteed column only, that's fine. You're still going to see it grow, but you can expect the growth on the dividend side as well. And so this is where we're going to look at for this conversation. We're going to be looking at the death benefit as it grows. We're going to be looking at the dividend side, the net cash value, and we're going to be looking at the cumulative premium. Okay, so the cumulative premium includes the base monthly payment on the hard cost commitment to the insurance carrier, plus the 100,000 in this example that we're putting in to the savings space. So in year one, the total cumulative premium is $111,048. You could see that on the left side here. On year two, we put another 111,048, which is again, 11,048 is basically $920.70 times 12. That's 11,048. And then the 100,000 is the savings. So that's how we get to 111.48. Okay. So year two, we put in 111.48. So on the cumulative premium side, we'll just see that added together on year two. So we have $222,097 on year two that we've paid into the policy. On year three, we put another 111,048. The cumulative premium is $333,145. So if we keep on going down this column, this is adding up year after year, the 111,048 added on top of the previous year, and all the previous years. That is our cumulative. Okay. Now, over here on the right side, the net cash value after the first year is $99,746. Okay, so that means I put in $100,000 in savings, and a year later, I have $99,746. Why is that? The reason why is there are a few insurance costs that reduce that cash value, but it's compounding interest. So now let's go to the next year. We have $222,097, and we have $207,488 cash value. Next year, we put in $333,145. We have $320,188. Now, if you notice, the death benefit is increasing every year along with the cash value. Year 4, we have $444,194, and we have $438,080. Year 5, here's where we break even and we start to outperform the base premium plus the cash value. We put $555,242. We have $561,537. Year 6, we have $666,290. We have $690,775. Okay, so I'm not going to go down every line, but let's skip now. Let's go down to year 10. We put in $1,110,484. We have $1,268,735. So by year 10, our policy is showing about $100,000 in compound interest growth. Okay, let's jump down another 5 years to year 15. Cumulative premium is $1,665,726, and we have 2.1 million. Let's keep going. Year 20, our cumulative is 2.2 million. We have 3.2 million. So at year 20, because of the power of compound interest, this policy has gained $1 million in compound interest growth. This column that I'm hovering on here can be borrowed from or borrowed against at any time. So the difference between borrowed from and borrowed against, when you borrow from, you take money out. So if you have money in a savings account and you want to invest that in a business or in a real estate or in a whatever, you're going to take it out of that bank account. You're going to put it in the asset or in the project. If the project performs well, you're going to get a return on investment and put it back in the savings account. Here, we're not taking it out, because if we take it out, what we're doing is surrendering the cash value. We don't want to surrender the cash value because, number one, we're going to pay taxes on it if you surrender it. Number two, we take it out of the policy and we stop that compound interest growth. So we're going to borrow against. And what that means is, let's say on year 10, I come here and I want to borrow $900,000 from this column of 1.26. Okay? So that $900,000 is not leaving the policy. It stays right here and it continues to grow compound interest. And I get a policy loan issued to me from the insurance carrier for $900,000. That policy loan is gonna I decide when and how much to make payment on the principal. Now, the policy loan does have interest. Right now with this insurance carrier, it's at 5.75%. So I do not recommend taking out all of your cash value, but taking out a piece of it, maybe around 60 to 80%. This way your compound interest growth in the policy is going to outperform the policy loan. And there's two things that I recommend you always pay. Number one, the base premium, and number two, the interest on the policy loan. And this way, the interest on the policy loan does not compound against you. And if you do that, then when you pay back the principal to your policy, the illustration that you see will go right back to the same numbers that you're looking at, because you pay the interest, but the principal you pay back at your discretion when you can, when you want to. Now, again, I recommend treating this like a line of credit and paying it back as quickly as possible, just like you would with a bank. But here, there is no due date for that principal. So, you might go a few months without any principal payment. You might go a few years without any principal payment and then pay it back in a lump sum. You may pay it back in increments monthly at your discretion. Okay? Now, here's a worst case scenario. If you invested that $900,000 and it was out of your savings account and that investment went south and you lost your money in the stock market, or you lost your money on an investment, in real estate investment, that's a 100% loss. But here, that $900,000 lost in your outside investment, if you're unable to pay it back or any portion of it, then what they're going to do is they're going to take that $900,000 out of your death benefit. So let's go down another 20 years to when you're 70 years old. Your life insurance policy now has $6 million of cash value, and you've only put $3.4 million in your payment. So that's double cash value. You've earned almost $3 million in cash value based on compounding interest. You have an $8 million death benefit over here. 15 or 20 years ago, you took out a $900,000 loan that you were unable to pay back for whatever reason or circumstances. You did make sure you paid the principal. You did make sure you paid your base premium, and you did make sure you paid the interest. And now this is when you pass away. Okay, knock on wood, we all live to be 110. Healthy and feeling great all the way through. But at this age, this is when you pass. So you have an $8.7 million death benefit. They're simply going to take the $900,000 out of the $8.7 million. So this is a self-fulfilling policy. It's going to cover itself. It's going to pay for itself, right? In the end. But in what I recommend you do is pay it back, because then you replenish the policy and you can continue to borrow from your cash value again and again and again and again, versus depleting your borrowing power by not paying back the policy. Okay, so this is infinite. This is a properly designed whole life cash value, high cash value policy with a major mutual company, where in this example, it's about 90% going towards the cash value, 10% going towards the base premium. We can also look at a 20-80 split, as well as a 30-70 split. I wouldn't go under a 30-70 split, where 70 is going towards cash value and 30 towards base premium. And the only reason you would do that is if you don't have as much urgency for early cash value, but you want that base premium to build up a bigger death benefit in the long run, and that's also okay. It's really based on what are your goals. Do you want to borrow from it right away, or do you want to wait 5 years, 10 years before you start borrowing from your policy? And again, this is an example based on $100,000 savings. Let's go ahead and click off of this one and take a look at the one with only $10,000. Okay, so we're gonna go down 10 years, $131,422. This one did not give us the cumulative, so I'll just add that up for us. So $11,773 times 10 equals $117,730. So in 10 years, there's $131,422, but the total amount paid in, including the base premium plus the cash value savings, was $117,730. So you made about $10,000 there. But let's go down another 10 years to when you're 20 years, when this guy is going to be 20 years old. 59 years old. So that's 20 years down the road. So again, 11,773 times 20 years. His cumulative premium was $235,460. And his cash value on the dividend scale is 334,000. So that's 100,000 earned. Let's jump down to when he's 80 years old. Okay, he'll have just about $1 million. That's 990,000 in cash value here. 989,183. If you notice, the premium stopped when he turned 32. I designed it to stop there. I'm sorry, when he turned 70, after 31 years. So we'll just do 11,403 times 31. That's 353,493. That's the total base plus cash value that he put in. And when he's 80 years old, that's $989,183, almost $1 million, where he only put in 353,493, and he has a death benefit of 1,166,597. And again, even on this smaller scale, he could borrow from this column at any time. So listen, it doesn't matter how much you do, whether it's 10,000, 15, 20,000. If you're saving money and you're putting it in a savings account with a bank, you're probably getting 0.03% on that cash value, right? If you are getting any kind of interest on that savings account, you're going to pay taxes on it. If you're putting your money in a 401k or IRA, you can't access it, and you're going to pay the future tax rate on that money when you do access it. This is an alternative saving strategy. Your money inside of this policy is protected from litigation in most states. It's protected from your losses if you borrow and are unable to pay back the principal, as long as you pay your base premium and the interest on the policy. You have a death benefit, which is legacy. You're gaining compound interest growth, which is tax-free growth in the policy. So instead of putting money in a savings account, enriching the bank, which, by the way, the banks own more of this type of insurance than anyone else on the planet, and it's only whole life mutual company life insurance that they purchase. They don't buy IULs. Not even the IUL companies buy IULs. They also buy a whole life insurance. So let's get that straight. But this is the safest place, in my opinion, the safest place to secure your money, to park your money, have access to it while it's growing, it's protected, and you're creating a generational legacy that cannot be defeated or beaten anywhere else through your death benefit. All right, so that's infinite banking. That's the strategy. That's an example. If you want to look at a design for yourself, then I just need to know your date of birth, the state that you live in. I just need to know how much you want to save every year, what you're committed to being able to pay on your base premium, and ultimately, we can design that. We can work together. Okay, so if it's not me, definitely, like I said, there's other people that I showed you that you can look at and learn from, and but definitely, definitely consider this for yourself. Hi, Wendy. I see you asked the question about Canada. I'm going to be honest with you. I'm not sure about Canada. I'm licensed in about 24 states in the U.S. I am not licensed in Canada. I'm not sure about it. But that's a great question, and I can get you an answer, and I can refer you to somebody in Canada that can help you with a policy like this. So I know, for example, my Chris Kirkpatrick, I mentioned from Life 180. At one point in time, he was partnered up with a gentleman, and they had an agency in Canada, and so I do know for 100% for a fact that you can practice this strategy in Canada. And again, I can get you a referral to someone that you can trust that's going to design it properly for you to make sure that it's advantageous to your purpose and your design. All right. So with that said, let's switch back over here. There we go. With that said, guys, just want to say thank you for joining me on my first live stream. Anyone who's here, I don't know if I'm frozen, if that's what's going on right now. My camera looks like it's frozen. If that's the case, I apologize. Let me go ahead and put it back to my screen because that looks really funny, having a frozen camera like that. Let me put it back over here. I appreciate you spending this time with me. I'm going to try to do this. Forget it. I'm not going to try. I am going to do this every Tuesday at 7 p.m. I don't have all the answers. I can get the answers. We can learn together. We can research together. So please, come back. Bring, tell other people about this. This is a place, no judgment zone, where we can learn from each other. You can participate, and we're just going to grow together, and ultimately living on purpose. So with that said, thank you so much for joining me. Make sure you like. If you didn't, make sure you subscribe to the channel and tell everyone else about it. God bless you, and have a wonderful rest of your evening. Take good care.